With Starbucks now hitting a new one-year low and approaching a multi-year low, paying over a 3% dividend, is it now time to take a sip of this coffee company? And Palantir is now down 14% on the day. After reporting some strong numbers, we're going to get into why it's still selling off here. And if you missed my video on Realty income, I'll leave it linked above, but we went through the earnings and I will tell you something here. I'm not super impressed with the growth rate of Realty income, and I do see maturity debts being a problem for growth for this company. And after a pretty substantial run up on Walt Disney Company, they come out with some interesting guidance here that's now driving the stock down 10% on the day. Is the magic gone in this company? Make sure you like and subscribe if you like this type of fundamental analysis. So let's get into it. So if you missed my video on Realty income, I want to point out a few different things that I'm starting to notice here. They have a lot of maturing debt coming between 2024 through roughly 2027, and we're in a higher interest rate environment, which is definitely going to impact earnings. But a few things I want to point out here is, number one, even though that they're growing their revenue, we're seeing that the efficiencies in the companies is not quite there. Going from $944 million of revenue to over $1.2 billion of revenue. We can see when we bring it down from a net income per share, not as efficient as they were last year. And from an FFO standpoint, still not as efficient as they were from last year. So what we're seeing is flat earnings growth, and that's why we're getting that flat pricing. They're basically giving us guidance of $4.17 to roughly $4.29 of funds from operation. So we're going to do some quick paper math here. Let's just meet in the middle and say they're going to do about $4.20 of funds from operation. I personally like to put between a 10 and 11 multiple on that, so I have some sort of capital appreciation there. When we put an 11 multiple on that stock, we get about a $46 price target. Now, obviously, we do understand that this is a dividend aristocrat. This is a company that has a really good balance sheet. And so we can pay a little bit of a premium here. So $46 to $50 makes a lot of sense for me personally. And when we bring that down, we basically need a 10 to 12% dip on the company from these levels to get to that price target. And when we line up that with a dividend rate of roughly 5.56%, we add an additional 10% of that if the price does fall to those levels, we're looking at a little bit over a 6% dividend yield with some capital appreciation down the road. And that's where I think it makes sense when we look at the 10-year treasury getting about 4.5% to 5%. I think in order to take the equity risk premium of a company like Realty Income, to start looking at what price do we want to buy the stock at and what dividend rate does it make sense, because the majority of the returns are going to come from dividends. And so I think anything over a 6% dividend, when you have a compelling case that a 3-month treasury is paying 5.5%, you definitely need to be beating a 3-month treasury, a 10-year treasury, and also have some sort of capital appreciation here in order to take on the risk of buying a stock. And so this is where I think it makes the most amount of sense to enter a company like Realty Income, which is now going to bring us down to Palantir. Palantir is down 14% on the day. Now, this is a company that was over $45, dropped down to $6 a share, and between $6 and $7 is where I came with my recommendations, and it shot up to $25 a share. So where do I stand with Palantir? Well, after reviewing the earnings, there was definitely some question marks here. I understand that they're beating earnings, but when you look at prior to this falling off, it was trading for over $55 billion market cap. And this company is earning roughly 4 cents on GAAP basis and 8 cents on adjusted basis, which means that you're paying a lot of money for 4 cents. Now, the thing I want to highlight here is don't fall for the revenue growth here. Revenue growth was projected to be over 25%, and we can see here that it's at 21%. Now, I'm not taking anything away from Palantir. This is phenomenal growth, but I want to keep it really basic here. They're showing you 21% revenue growth. But what is the big problem with this? The big problem is the company went from 2.2 billion shares outstanding to now 2.4 billion shares outstanding. That's just under a 10% increase on shares outstanding. And so when we subtract that 21% growth rate versus how many shares they're putting on the market, the net growth on this company is actually not as strong as anticipated. And earnings also are not growing at the speed that I personally would like. And so this is definitely a red flag for me personally. And so a few things I want to point out here. A lot of people are going to talk about the clean balance sheet that Palantir has, and that's absolutely true. They have over $3.3 billion in marketable securities, basically rolling over T-bills, while still sitting on $520 million of liquid cash. So yes, the balance sheet is very clean, but here's the concerning part. They're showing you net income of $106 million. The problem with this is probably 20 million of that dollars is coming from that $3 billion of T-bills that they're rolling, but the true business itself is only showing 13% margins in $81 million of GAAP income. So the way that they're presenting this is a little bit deceiving here, because you're thinking that the business is actually having 17% margins and doing $106 million. And you're also thinking that the company's growing 21%. But when we net everything out, it's really not the case. And so this is where my concern is for Palantir. And I would actually say overall, the stock is holding up a little bit better than I anticipated. I actually thought there was an opportunity that we could see high teens once again for Palantir, which is now going to lead us to the Walt Disney Company. They've definitely been executing, getting their cost structures under control, but the forward guidance of a slowing consumer seems to be what's driving the stock down, along with some streaming issues here. Now, I did a price target a few years ago in 2022, getting an ideal price target right around $75. So my wife did get a lot of fills in the $80 range, and she's up pretty substantially in Disney. We did sell some of those proceeds in the high 110 area, 112 area, and started rolling some into Starbucks. But if I were to look at Disney right now, I would say anywhere in the mid 80s to low 90s makes a lot of sense, because I still do think they're going to start reaching that 150, 170, 2030 price target. I think they're still executing at a high level and still have a lot of levers to pull here to still be successful, even when the consumer is slowing down. So to buy a company on a dip like this, I still think it needs to go lower. But if you were able to enter anywhere between $75 to $90, I think you did a pretty good job here. I don't think you need to add any more. But if it does get back down to the high 80s, low 90s, and you're interested in Disney, I think it's okay to nibble at these levels. Which is going to lead us to Starbucks now. Starbucks has fallen off of a cliff, and now we have to start looking at the company and figuring out where does it make sense. I think for Starbucks, I would reach a little bit here. I have an ideal price target between $63 to $66. So now that it approaches anywhere between $68 to $72, I think makes a lot of sense to start nibbling into Starbucks. This is a great way to get some foreign exposure, especially if you want some exposure to the Chinese consumer without actually taking on the risk of owning Chinese stocks. And then you also own a very strong brand. And so I definitely think Starbucks is now in the wheelhouse of a good risk versus reward type of price target. Basically anywhere from that $63 to $72 mark, I think makes a lot of sense for Starbucks. And guess what, guys? We just broke $72, and this is where I think it does make sense to start looking at Starbucks. Once again, this is just my opinion. As always, appreciate everybody's time. We will see you in the next one.